Welcome back to the Financial Pulse. The silver market is showing a notable structural development. Reports suggest that certain refiners have temporarily reduced or paused purchases of 90% silver coins, affecting the usual flow of supply in specific channels. This shift isn't just a minor blip. It could impact pricing dynamics, liquidity, and broader market sentiment in ways few investors are anticipating. As we break down the reasons behind this abrupt pullback and examine what it means for market participants, pay close attention, comment with your observations, and follow the patterns that might shape the coming weeks. This content is for informational and educational purposes only and should not be considered financial advice. 90% silver coins occupy a unique position in the bullion ecosystem, representing a legacy form of precious metal that bridges historical minting practices and modern market dynamics. Composed primarily of silver with a minor copper alloy, these coins were once the standard circulating tender in the United States and retain both numismatic and intrinsic value. Historically, refiners have treated 90% silver as a highly liquid standardized feedstock, routinely acquiring them to extract bullion for industrial use, coinage, and secondary market redistribution. Their uniform composition and established grading conventions allow for relatively predictable valuation, which is critical for institutions managing inventory, hedging exposure, or facilitating secondary sales. Beyond industrial considerations, 90% silver coins maintain strong appeal among collectors due to rarity, historical provenance, and condition-sensitive premiums, which can decouple their trading behavior from spot silver prices. This dual demand structure, industrial liquidity paired with collector scarcity, has traditionally reinforced steady flows through refiners, creating a transparent conduit for both physical distribution and price discovery. The current halt in purchases, therefore, is not merely an operational adjustment. It interrupts a historically reliable mechanism that underpins both market confidence and physical accessibility, highlighting how structural dependencies can amplify the significance of what might otherwise be considered a niche segment within the broader silver market. The silver market right now exists within a complex interplay of structural pressures and macroeconomic influences that go beyond headline price movements. Over the past several months, spot silver has experienced moderate volatility, oscillating within a range that reflects both investor caution and constrained physical availability, while futures volumes suggest that paper-driven positioning continues to dominate near-term sentiment. Supply-demand imbalances are increasingly pronounced. Mined output has remained relatively steady, but refined physical coins and bars, particularly historically standardized forms like 90% silver, are seeing constrained flows due to operational limits and institutional credit restrictions. On the demand side, industrial consumption remains resilient, driven by electronics, photovoltaics, and specialized alloy requirements, but these are increasingly competing with collector-driven premiums that elevate certain physical segments above spot valuations. Broader macroeconomic variables amplify these pressures. Rising interest rates continue to weigh on opportunity costs for holding non-yielding assets, while inflationary trends sustain a baseline level of hedging interest in precious metals, creating an environment where price discovery is mediated as much by structural accessibility as by speculative positioning. In this context, market participants face a decoupling between paper silver pricing and the availability of physical metal, particularly in forms that historically facilitated institutional and retail flows. Understanding the silver market today requires analyzing these overlapping incentives, operational constraints, macroeconomic pressures, and the persistent divergence between paper and physical channels, each shaping liquidity, delivery risk, and potential premiums in ways that are subtle but critical for assessing near-term dynamics without resorting to simplistic bullish or bearish narratives. Refiners, recent pause in purchasing 90% silver coins reflects a structural recalibration rather than a reactionary response to market sentiment. This shift is closely tied to operational and financial constraints that have accumulated over time, illustrating how incentives and capacity shape supply flows in ways that are often invisible to outside observers. Credit limitations play a central role. Refiners typically rely on short-term lines of financing to acquire large quantities of standardized silver, and when these lines are constrained, whether due to institutional risk assessments, collateral requirements, or broader banking prudence, the ability to maintain consistent purchasing schedules is compromised. Operational challenges compound the issue, as the refiners must manage not only the physical handling of high-volume coins, but also assay verification, purity certification, and secure storage, each of which introduces capacity bottlenecks that can make incremental purchases inefficient or financially imprudent. Regulatory considerations further influence this behavior. Even absent explicit restrictions, compliance frameworks around anti-money laundering, reporting obligations, and trade documentation create a layer of procedural friction that can slow or temporarily halt acquisition, until institutional confidence in risk management is reestablished. Viewed through the lens of market mechanics, these pauses are predictable outcomes of interdependent constraints rather than signals of panic or impending dislocations. They underscore the distinction between paper pricing and actual physical availability. While futures contracts and spot quotations may continue to oscillate, the tangible flow of 90% silver through refiners has a structural ceiling determined by credit, operational bandwidth, and regulatory adherence. Historical precedent supports this interpretation, showing that temporary halts in refiner buying often coincide with periods of broader institutional recalibration, where the priority shifts from aggressive accumulation to controlled risk management. In essence, the current purchasing pause highlights how deeply embedded operational and financial factors can govern market behavior, emphasizing that disruptions in supply channels are often procedural rather than speculative, and that understanding these underlying mechanics is crucial for assessing both premiums in the physical market and the potential decoupling from paper-based price signals. The immediate market reaction to refiners halting purchases of 90% silver has been nuanced, reflecting a convergence of structural constraints and participant recalibration rather than a dramatic price shock. In the first days following the pause, trading volumes in physical coins and bars experienced a measurable contraction, particularly in the segment directly tied to standardized 90% silver units, as dealers adjusted inventory and reassessed delivery schedules. Spot prices showed localized pressure in certain retail channels, where premiums above benchmark quotations widened modestly, indicating that scarcity in the physical conduit was being absorbed into price signals without triggering broad panic. Futures markets, by contrast, maintained relative stability, with open interest and contract turnover, suggesting that institutional players were largely interpreting the halt as a procedural or operational adjustment rather than a fundamental demand-supply disruption. This divergence between paper and physical markets underscores the persistent decoupling that can occur when liquidity in tangible assets is constrained, a phenomenon observable in previous episodes where institutional or credit-related bottlenecks limited access to actual metal despite continuous pricing in derivatives. Bid-ask spreads in secondary markets for 90% silver coins widened slightly, reflecting delivery risk and temporary uncertainty about refiner participation. But historical patterns suggest such spreads often normalize once institutional workflows realign and operational confidence is restored. The market also displayed a subtle feedback loop. Smaller retail participants, perceiving tighter availability, accelerated certain purchases, which further emphasized premiums in niche channels, while larger wholesalers remained cautious, avoiding aggressive accumulation until clarity emerged regarding refiner credit and capacity. Price discovery in this environment becomes a layered process, where observable quotations are influenced not only by traditional supply-demand fundamentals, but also by operational bandwidth, delivery certainty, and counterparty risk. The overall picture indicates that while the halt has introduced short-term frictions and a modest premium repricing in physical markets, it has not disrupted broader market equilibrium, and volatility metrics in both spot and futures contracts remain within historically reasonable bounds. This measured reaction highlights the importance of distinguishing between structural constraints and speculative sentiment, demonstrating that immediate market adjustments are often more reflective of operational realities than of shifts in intrinsic value or investor psychology. Credit limitations imposed on refiners and key suppliers function as a structural bottleneck within the silver market, directly influencing the velocity at which 90% coins and other standardized bullion can move from source to secondary distribution. Refiners typically operate on thin margins, relying on short-term lines of credit to finance acquisitions, cover assay and processing costs, and maintain working capital for day-to-day operations. When these lines are curtailed, whether through tighter bank scrutiny, revised risk assessments, or collateral requirements, the immediate effect is a reduction in the volume of metal refiners are able to acquire, even if underlying demand remains unchanged. This constraint does not exist in isolation. It cascades through the supply chain, limiting availability for wholesalers, who in turn must recalibrate allocations to retail dealers. The downstream consequence is a subtle but measurable tightening of physical flows, reflected in slightly elevated premiums, elongated lead times, and more selective fulfillment policies for high-demand items. From an operational standpoint, credit limits force refiners to prioritize certainty over speed, often focusing on contracts with established counterparties and delaying incremental acquisitions that might otherwise be routine. This creates an environment in which the friction in the delivery pipeline is structural rather than speculative, with liquidity constrained not by market sentiment but by practical financing capacity. Historical precedents show that periods of restricted credit typically produce temporary decoupling between paper and physical markets, where futures contracts and spot pricing continue to reflect theoretical liquidity while actual metal remains less accessible. Retail participants may perceive scarcity, but institutional behavior is largely guided by credit prudence, risk-adjusted positioning, and inventory optimization, which tempers the potential for reactive buying sprees. Ultimately, understanding these credit-driven dynamics clarifies why supply limitations in physical bullion can emerge even in the absence of extraordinary market pressure, emphasizing that operational and financial constraints at the refiner level play a fundamental role in shaping availability, pricing structure, and delivery risk throughout the broader ecosystem. Recognizing these bottlenecks provides context for observed market behavior and underscores the importance of integrating structural capacity considerations into any assessment of silver liquidity or premium fluctuations. A pause in refiner purchases of 90% silver has repercussions that extend far beyond the immediate acquisition point, rippling throughout the broader silver supply chain and highlighting the interconnectedness of production, distribution, and market access. At the mining level, output remains relatively consistent, but the ability of mined silver to transition efficiently into refined, saleable units is constrained by processing throughput and operational sequencing at refineries. When refiners reduce or temporarily halt acquisitions, bottlenecks emerge, delaying the transformation of raw or semi-processed silver into standardized coins and bars that downstream participants rely upon. Wholesalers and secondary market operators experience a compression of available inventory, which forces them to adjust allocations and reprioritize deliveries, often leading to extended lead times and uneven availability across regions or channels. Retail dealers, in turn, encounter constrained supply, reflected in modestly elevated premiums over spot prices, selective product fulfillment, and the occasional scarcity of historically popular coin types. These effects are compounded in markets where collector demand intersects with industrial consumption, as both segments compete for the same refined units, creating localized supply tension that is structurally induced rather than sentiment-driven. Historical patterns indicate that such pauses can generate temporary decoupling between paper pricing and physical availability, where futures markets and benchmark quotations continue to reflect theoretical liquidity even as tangible metal is slower to circulate. From an operational perspective, this chain reaction underscores how refiners function as critical nodes within the market ecosystem. Any limitation at their level amplifies downstream effects, influencing pricing signals, delivery risk, and participant behavior throughout the network. Observing these dynamics highlights the systemic importance of physical infrastructure, credit capacity, and procedural continuity, demonstrating that even brief interruptions can influence delivery timelines and inventory management, though broader market dynamics remain stable. Recognizing the structural nature of these ripples equips market participants to interpret shifts in premiums, availability, and logistical bottlenecks more accurately, reinforcing the principle that liquidity and price behavior are as much a function of operational mechanics as they are of broader economic sentiment. Silver markets have experienced episodic supply disruptions throughout history, and examining these instances provides valuable context for understanding the current pause in refiner purchases of 90% coins. One instructive comparison can be drawn to mid-20th century periods, when minting adjustments or geopolitical factors temporarily limited the flow of standardized silver into circulation, creating short-term bottlenecks without fundamentally altering long-term value trajectories. In those cases, premiums on physical units increased modestly relative to spot, reflecting constrained availability rather than speculative demand surges, while futures and paper contracts continued to trade in line with broader market expectations, illustrating the recurring decoupling between paper pricing and tangible metal accessibility. Another parallel exists in episodes where refiners faced operational interruptions due to credit tightening or regulatory scrutiny. Historical records show that these pauses often produced localized supply pressure, forcing secondary distributors and retailers to adjust inventory management and pricing structures. Yet over time, normal flows resumed once structural constraints eased. Observing these patterns emphasizes that physical supply bottlenecks are rarely binary or permanent. They are dynamic, probabilistic events that propagate unevenly across the market, depending on operational capacity, institutional behavior, and credit availability. Importantly, these historical precedents also underscore the layered nature of risk. Delivery delays and premium expansions emerge as operational and financial phenomena, rather than indicators of systemic market collapse. The variability in outcomes highlights the necessity of integrating both structural and macroeconomic factors when assessing short-term dislocations. Similar supply interruptions in gold, platinum, and industrial metals have demonstrated that market adjustments often manifest through temporary spreads and liquidity constraints, rather than immediate valuation shifts. Recognizing these patterns provides a framework for interpreting the present situation with 90% silver coins, offering insight into how bottlenecks, credit limits, and procedural pauses historically interact with broader market mechanisms. While no historical analogy can predict exact outcomes, past behavior suggests that disruptions of this nature are typically absorbed over weeks or months, with premiums normalizing as refiners and distributors reestablish operational equilibrium, and that attentive observation of physical flows and institutional positioning yields a more accurate assessment of market health than reliance on headline pricing alone. The current environment in the 90% silver market presents a layered set of risks and sensitivities that vary depending on participant type and position within the supply chain. Industrial users, for instance, face exposure primarily through delivery risk and timing, as operational pauses at the refiner level can delay the acquisition of standardized bullion necessary for manufacturing, electronics, and specialized alloy applications. These delays are not reflective of speculative pricing swings, but rather a structural constraint on physical flow, which can necessitate inventory buffering, staggered production schedules, or substitution with alternative material sources, each carrying measurable cost implications. Investors in physical silver similarly encounter a distinct set of sensitivities. While spot and futures pricing continue to provide transparent benchmarks, the divergence between paper markets and tangible metal availability introduces potential premium variability, particularly for historically standardized coins that are now subject to tighter distribution. Premiums may reflect adjustments by wholesalers and retail dealers in response to operational factors, a pattern observable in historical bottlenecks. But the underlying intrinsic value of the metal remains tied to long-term fundamentals rather than short-term liquidity disruptions. Collectors experience a compounded effect of scarcity and operational friction, with limited access to coins of certain mint years or grades temporarily amplifying competition for available units, which manifests in localized premiums rather than broad systemic shifts. Across all participant types, these sensitivities are amplified by institutional behavior. Wholesalers and refiners tend to prioritize risk-adjusted allocation, favoring counterparties with established credit and logistical reliability, thereby reinforcing operational hierarchies that affect accessibility for smaller market actors. Historical data suggests that such structural vulnerabilities are cyclical and largely self-correcting once procedural and credit constraints normalize, but they remain significant indicators of how finely balanced the physical market infrastructure is relative to paper market representations. This assessment highlights the importance of monitoring both tangible flows and institutional positioning to evaluate market health accurately, as well as the necessity of distinguishing between operational risk and speculative risk when interpreting premium shifts, delivery delays, or temporary imbalances. Understanding these sensitivities allows participants to anticipate logistical pressures, assess potential exposure, and interpret price signals in context, reinforcing a disciplined approach to market observation grounded in structural analysis rather than headline reaction. The refiner's decision to pause purchases of 90% silver represents more than a momentary operational adjustment. It signals a convergence of structural constraints that have the potential to redefine short-term market liquidity in subtle but meaningful ways. While on the surface, the halt may appear as a routine procedural measure, a deeper examination reveals that it is rooted in interlocking limitations of credit access, operational capacity, and regulatory oversight, factors that collectively shape the physical distribution network and influence the translation of theoretical pricing into tangible availability. Credit constraints, whether arising from bank-imposed limits, collateral requirements, or institutional risk management protocols, create a cap on the volume of silver refiners can acquire without exposing themselves to disproportionate financial risk. This, in turn, constrains the flow of standardized coins and bars into wholesale and retail channels, producing a situation in which spot pricing and futures markets continue to function with apparent normalcy, while physical metal becomes selectively accessible. Operational flow issues further compound the effect. Refiners operate with finite processing throughput, limited storage capacity, and procedural verification requirements for assaying and certifying coin purity, meaning that even modest reductions in acquisition can ripple through distribution timelines and create localized scarcity. Regulatory and compliance factors add another layer, as adherence to reporting standards, anti-money laundering protocols, and documentation obligations imposes a friction that cannot be bypassed, effectively creating a structural throttle on market participation. The interplay of these elements produces a temporary decoupling between paper and physical markets that can manifest in widening premiums, delivery delays, and uneven availability across different segments. Recognizing this is critical for participants because it reframes how liquidity should be interpreted. Rather than viewing short-term price fluctuations as a reflection of investor sentiment alone, they must be understood in the context of operational and credit limitations that impose tangible boundaries on physical movement. Historical patterns reinforce the significance of this type of bottleneck. In prior episodes of refiner or supply-side pauses, markets displayed muted price response relative to actual scarcity. with premiums adjusting incrementally while institutional players maintained measured allocation strategies, highlighting that these disruptions are procedural rather than speculative. The current environment mirrors these dynamics, but with one notable nuance. The scale of 90% silver circulation and its dual appeal to collectors and industrial users intensifies sensitivity to any pause in refiner participation. Even brief interruptions can amplify delivery risk, prompt temporary inventory hoarding, or create subtle tension between market segments, revealing the delicate balance that underpins the physical bullion ecosystem. For market observers, the critical insight is that this pause is not an isolated hiccup. It represents a structural constraint that, if prolonged, could shift the near-term posture of the market by affecting how readily physical silver is available for settlement, redistribution, and fulfillment. Participants should internalize that liquidity. In the short term, is no longer simply a function of paper pricing or theoretical supply. It is directly mediated by operational bandwidth, credit availability, and procedural compliance, factors that collectively define the practical contours of market behavior. Understanding this turning point allows for a more nuanced interpretation of observed premiums, delivery delays, and allocation patterns, highlighting the underlying mechanics that drive market responses without relying on speculative narratives. Observers can gain insight into the structural factors affecting the market, how these constraints might interact with ongoing macroeconomic pressures, industrial demand, and collector behavior, providing a framework for interpreting market signals in a way that distinguishes between transient operational bottlenecks and long-term value dynamics. This recognition reframes near-term market assessment from a reactive perspective to one grounded in structural observation, emphasizing that the real driver of immediate liquidity and pricing is less about sentiment and more about the operational realities that govern the movement of physical silver from refiner to end user. The recent halt in refiner purchases of 90% silver underscores that supply constraints in the physical market are real and structurally significant, rather than the result of short-term speculation or headline-driven sentiment. While spot and futures prices continue to provide reference points for valuation, the observable friction in acquiring standardized coins and bars reflects operational capacity, credit limitations, and procedural compliance, all of which shape near-term market accessibility. The market is actively adjusting to these constraints, with wholesalers and retail distributors recalibrating allocations, modestly widening premiums, and prioritizing certainty in delivery, producing measurable but controlled effects across supply channels. Observing these dynamics closely allows participants to interpret shifts in premiums, delivery timelines, and inventory flows through a structural lens, distinguishing operational frictions from speculative pressure. For industrial users, investors, and collectors, this requires careful attention to allocation patterns, counterparty behavior, and logistical bottlenecks, as these factors directly influence liquidity and delivery risk. Recognizing patterns, asking critical questions about supply chain behavior, and exploring deeper analysis provides insight into the broader implications for both physical and paper markets, enhancing understanding of structural market mechanics. Maintaining a disciplined perspective on these evolving dynamics helps participants interpret signals accurately and avoid reactionary decisions based solely on price movements. Engaging with these observations critically, sharing analysis, and following developments over time strengthens market insight and situational awareness. For those aiming to stay informed and refine their understanding of silver market behavior, subscribe for ongoing market analysis and commentary grounded in structural realities, operational constraints, and informed interpretation, equipping viewers to navigate these unusual conditions with clarity and foresight.